Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited. We're going to answer your questions specifically about retirement planning, how to manage money in retirement, how to reduce taxes. And you can do that by sending in those questions now if you'd like here at the email address, or you can put it in the chat and we'll try to answer them live. You can send in the email during the week and we'll try to answer it next week. And we always try to answer questions that come up in our client strategy sessions, which are, usually a pretty good source for some of what we talk about. And so altogether, we're, going to be, looking at, the channel here and adding to the channel. This is something we put together, this Talk Money with Tom, just because we felt like there wasn't enough content out there in these particular areas, trying to help out here. Specifically started off with the clients, and others have joined in, so that's nice. And so you can subscribe to the channel if you'd like to. Add little bell buttons next to that, gives you content as we put it out. And of course, if you just want to meet with us, you can do that also. We have a book appointment button up in the corner of our website. It looks just like that. You go there, the link's here on the channel. And you can set up a 30-minute time to meet with Ethan and I, and we'll answer your questions, specifically. So anyway, looking forward to being able to help you as far as that goes. Send in your questions now so we can start to answer them. And we always start off the show at the beginning here with just a summary of kind of what we saw happening in the stock market this week. Of course, we've been looking at this chart, week by week for quite a few years here, actually. So I've been keeping it going. This goes back to kind of the middle of 2018 there. And so this week was interesting. Monday was up, but then Tuesday, Wednesday, and Thursday were all down, kind of in that half-point range, half percent. And most of it was started off in a conversation that Chairman Powell was having. I think it's the Rhode Island Chamber of Commerce or something like that, that he was doing a little speech and a question and answer. A couple things. He talked about how basically he wasn't going to commit to another 2 rate cuts. All right. And that's what he always says. I don't know why the market respond to that in one way or another.
He can never really commit to any kind of thing for anything with certainty.
No. And, we still have more data to be, gathered between now and the October meeting. And so, there's a little bit of concern there. The thing I found the most interesting, though, was he was talking about inflation being temporary. Because of tariffs, a one-time bump in inflation. They were going to try to make sure they kept it at that and that didn't get any more out of control. This sounds a lot like what we were hearing in 2021 when we heard about transitionary inflation being caused by the reopening after the pandemic. They weren't really wrong, actually. A lot of that was very accurate. The problem was the length of time it took for everything to go through.
Yeah,
so
a 3-year period is that considered transitionary?
Yeah, for most people that are living, in the daily world here, 3 years can be quite a while, especially as you saw some of the prices really skyrocket. So I thought that was interesting. They have to choose a path, right? They've got to go down the path of fighting inflation or helping the job market. Job market has been getting softer. The number of new jobs that have been created this year is down substantially from years prior. And so, we've got this situation where the Fed can decide, in this case, they're going to go down the path of helping labor, right?
Yeah, they rather help the labor than, having and worry about inflation later.
And we've talked about on the show a couple times that we don't disagree with that, actually. The rate cuts are okay in a scenario. The problem is that people are worried about inflation because if you cut rates, you stimulate the economy, you make the stock market better theoretically, and people have more money, they spend that money, and inflation gets even worse, right? But we're in a situation where job losses are coming through, layoffs are up, unemployment's up to 4.3%. So there's a softness, I think, in the demand overall. There's some room to lower some rates because the prices are probably going up anyway because of tariffs, right?
So there's not going to be a spike in demand because of the rate hike.
Right, exactly.
They're trying to play that.
But they're going to get some blame for that spike in inflation, watch, because there is a known correlation between lowering rates and having, prices go up. And so if prices are going up and they're lowering rates, it's a really weird time, right? You got a gross domestic product that was just adjusted from 3% to 3.8% in the second quarter. That happened this week. Very strong. Consumer spending is quite strong. You don't cut rates in this environment in a normal scenario. And the stock market is at a nearly an all-time high. I mean, all these things, they actually bode fairly well for the stock market historically. When you look at when these types of cuts have happened in the past, when they've had, a decent economy and a stock market that's relatively high, it has often propelled the stock market even higher. And that certainly seems to be happening now. We did get like 3 down days. I mean, they were fairly broad and they weren't, huge or anything, but we haven't had 3 down days in quite a while, probably since April. So, they kind of caught attention. But today the market's up a little over 0.5%, and this is the main, reason for that as far as I'm concerned. Although I will say, I've been saying all week that I thought dip buying would come in. Dip buyers aren't gone yet. At some point, maybe. But, a 3-day drop is a perfect situation for people to come in and buy. And so we got the PCE report today. Okay, so this is the core and top line PCE, which is Personal Consumption Expenditure Index. Chairman Powell talked about this on Tuesday, actually. And so this is the last year. You can see it's at 2.91%. It's been coming up ever since April.
Yeah,
okay?
but it came in at expectations. So
Yeah.
what the consensus expectations were.
It came in exactly at expectations across the board, actually, both on month to month and core versus top line, which, okay, so we'll talk about that, because can we trust these numbers? Now we got a person who's been fired because it came up with numbers that the administration didn't like. Does a new person want to keep his job? And maybe the numbers aren't as accurate. We will never know anymore. So once you've fired somebody, it does make it a little bit more
once
difficult.
you question the data, it's hard
Yeah,
to ever get
and
the
so
full trust again.
Is this the real data? Is this really, is inflation tame or not tame? It's interesting. And however, I will say, just looking at this chart overall, the inflation rate year over year was actually higher at the end of last year. So, we're kind of coming back up. We were up before things fell back down to a low in April and May, so is this just noise that's happening, or is this the beginning of kind of the motion forward for, from the tariffs increasing price? So one of the things that we're starting to do here, and we'll present on the show here, is alternative places to look outside of the numbers provided by the government. Okay, so a couple of weeks ago we talked about this commodity index. This is an ETF through iShares, precious metals and energy, and there's like 5 categories of commodities. And so again, this is roughly a little over the last year. And you can see the trend is definitely up. And this was 2 weeks ago. Here's the slide for now. So if you look closely, you can see we're even higher than we were a couple weeks ago. And however, even then, we're at a high point that we were at, less than a year ago, and we actually have a point, right in the June timeframe that's higher than where we are now. So you got to watch out. Sometimes it's just noise. Things kind of move for a while, but the trend, and we'll keep track of that. We'll keep watching this, because I think this is going to be one of the things that can kind of show inflation in real time. Mm-hmm. You can't really hide, the cost of these commodities as far as that goes. So anyway, that's one place to look. The other thing that's happening, of course, is the bet on
Rate cuts.
Rate cuts. Okay, so really strongly leaning towards 2 rate cuts this year. Now, the Federal Reserve, in their dot plot, state economic projections, the SEP, they came out and said 2 rate cuts themselves also. Now, it was really bifurcated. It's kind of weird. It was like 9 to 10 for 2 rate cuts. So it was very, close. So we'll see what actually happens. But there's 89.8% chance of a rate cut coming up here in October. And that's going to be October 29th. And then on December 10th, I was at 19th, sorry, December 19th, there's still another 2/3, 67%
It's
chance.
December 10th, yeah.
Yeah, 67% chance of a second rate cut. Okay, so that's important. The reason that's important is because that's already factored into the market, and so that's why if Chairman Powell doesn't commit to it during his speech, it kind of lets the participants know, it's not guaranteed, and that brings that back down a little bit.
Yeah, you can really tell, like with last week's rate cut, the market was flat. on that
Yeah,
day. There
yeah.
wasn't really any movement up or down. It
Right.
was kind of came into expectations,
Completely expected.
and
Yeah.
the market just moved on.
Right, the market was already there. There wasn't anything to really react to because it happened. It would have been more of a reaction if it was a half a point rate cut or no rate cut, because the expectation was in the 90 percentile. I remember maybe even 97 percentile of that they'll do one rate cut. So anyway, that's happening. Now, the other thing that comes up in some of the questions is just we're looking at the possibility of a government shutdown, right? I'd say it's a really high probability that it's going to happen. The Democrats want to use this to point out the Medicaid cuts. They don't want to agree to fund, you know, the government if we don't have some, you know, take back on some of those Medicaid cuts. And so I think they're asking for a lot. I can see what they're trying to do, but I also don't see an avenue out of that other than somebody capitulating at some point in time. So that could take a little while. And so, however, let's look at how it's done in the past during, you know, rate cuts. During government shutdown. And if we look here, 79, you know, during the shutdown, it was down 4.4%, but it was up in 2013. It was up 10% on that's the longest, you know, shutdown in history, was that 35 days that happened at the end of 2018, beginning of 2019. Market was up 10% during that period of time, that 35 days, which is a pretty big jump, actually. And you had a 24% gain 12 months after. So the average for these shutdowns is the market is actually up during these shutdowns on average, and then 12.7% up after these shutdowns. So these generally aren't market-related events, but these are a little bit different. They're talking about these mass layoffs as kind of a counter threat to the Democrats, saying, hey, you know, if we close down the government, we're going to lay all these people off. And, you know, it's kind of what we wanted to be doing anyway. Does that have an impact, you know?
Yeah, we'll see, because I remember they made a similar threat the previous budget
Right.
shutdown, or possible shutdown. So will the Democrats kind of just let go or move on?
Yeah, and is it a good threat or not? I mean, you know, the whole Doge thing came through and they laid off all these people, and there's a lot of stories out there about how many people they're trying to get back. You know, I mean, the government is a certain size, it's a certain efficiency, whether that's good or bad, it's still there, and things still need to be done. And so, you know, you eliminate everybody, it doesn't get done. And, you know, at the top, that sounds good. It slims down the bottom line. It's one of the strategies that they do in a lot of these tech companies. As like when they came in to take over Twitter, right? I mean, they just kind of clean house and get less people to do the same job and get rid of a lot of overhead regulations, concepts. And so, you know, it could work in the U.S. government also, but it's not that easy, and it takes some time.
And there's a lot of things that break during that kind of, if you do very fast cuts.
Yeah, and it's not the same as Twitter. Twitter, you know, if it's not working perfectly, some things are slipping out that shouldn't be, or whatever it is. If the federal government's not working, people aren't getting paid. They usually have deferred, and they get paid eventually, but you know, imagine not getting paid for 35 days, worrying about the layoffs, and, you know, there's all these people that need these services, right? And so what's considered critical, what's not, what stays open, what doesn't, you know, those are real life problems from doing this too.
Yeah.
So.
But Social Security is one of those things that will always be considered critical, so those will get paid out.
Yeah, exactly. So, I mean, we've not seen, I mean, in that 35-day shutdown, I remember that's pretty specifically, things went along okay. It's amazing they do consider quite a bit of the pieces that I think are critical as critical, and they don't shut down, you know, the FAA and, you know, these different things. So the weird part is that in a lot of these cases, I believe these people are expected to come to work as critical employees without pay. With the idea being
You'll get back pay.
kind of an IOU type of thing. Yeah, they'll get the back pay, but that'd be interesting. Not a normal job situation. So anyway, that's what's happening, you know, with the stock market this week. I think there's a lot going on this week. I think it's kind of interesting. I believe the market is still going up. It is poised to go up, really. We've got 2 more rate cuts coming, most likely. You've got a situation where, we're heading into eventually the better part of the year, November, December, which are, generally the year-end rallies come. We don't have any weird things like, big midterm elections or, it's just a normal time frame for year-end. I think the market probably hangs in there and does well. I think longer term, we've got some issues with, can earnings keep going? Can inflation, if that commodity price keeps going and higher and higher and higher, all of these different things that we're going to watch even outside of the government numbers, do those continue to do well or not, right? So we'll see. But so far so good, and things are moving along pretty nicely. So, okay, that's good. What's our first question?
Should we expect inflation to keep going up, for the next few months, next year? How long do we expect inflation to continue?
Yeah, actually, if you listen to Chairman Powell on Tuesday, speaking at the Rhode Island Chamber of Commerce or whatever it was, he talked about expectations for inflation here in the fourth quarter going up. And I don't know, he didn't say it all directly. A lot of it was, if you listen and you kind of have to read between the lines with the Federal Reserve, at least in my opinion, they were talking about how you're going to end up with higher costs. They're trying to deflect some of that, or maybe pre-announce that in a way, to deflect, because I think they're worried about some of the blowback they're going to get from the market itself, if not from the press, about lowering rates during a period of time when the economy is doing pretty well, and the possibility of inflation. So
Yeah, I think they're in a tough position because they're trying to preempt if a job market slows down too much, it's kind of like you lose all momentum and you have to start it up again. So trying to pump it with gas while it's still moving okay is the kind of idea, trying to give it a push then, rather than once it completely stops.
Yeah, no, I think to answer the question, yes, we should expect more inflation. We are still absorbing the impact of tariffs. It's been a little while now, but they did a study, which I mentioned before, where 15% of tariffs are being paid by the exporting company or exporting country, right? 15% are being paid by the consumer, and 70%, I'm rounding here, but 70% is paid by the company. And so the companies are eating this so far. That probably won't continue. As a matter of fact, the study said that within 24 months, they expected that to flip. 70% of the increase would be paid by the consumer, and 15% would be paid by the company. So that flip is in the process now. So tariffs are here. Of course, new ones are being announced all the time.
Yeah, and we still know what the legality of the ones based on countries is.
Right.
And so we'll be kind of seeing what's going on.
I think the bet right now is a 60% odds that that the Supreme Court actually votes in favor of the lower court's opinion, which is that these tariffs used under this emergency declaration are actually illegal. I think they lose these. And so what they're doing right now is they're announcing line item tariffs. Pharmaceuticals, heavy trucks. There was a list today that came out with several things they're working on.
It's supposed to start on basically next week, October 1st.
Yeah, with a really short time frame. October 1st, we're going to have 100% tariffs on branded pharmaceuticals coming from outside the country, with a bunch of exceptions, of course. And but I think we're just getting started on the tariffs here. And so that's what they'll do, because the line item tariffs are being allowed, right? And they are allowed, versus these emergency tariffs, which are probably going to be disallowed or have a chance to be disallowed. So anyway, yeah, I suspect that as you see all these things coming through, you're not going to see these companies have the ability to continue to absorb this cost. I mean, we'd already talked about, Apple was talking about $800 billion, General Motors 1.1, I said 800 million, sorry, General Motors 1.1 billion, right? And these are, expected costs for tariffs that they're going to eventually have to pass on, because the margins aren't high enough, and their stock prices, still have, as a public company, you still have an obligation to the shareholders, not the president, not your consumers.
So yeah,
you have a legal obligation to your shareholders, and so if you're not passing that along,
a lot of lawyers are always willing to sue companies for shareholder things, so they don't want to mess with that.
Shareholder lawsuits are a big deal, and there's big business there. So yeah, that's what's coming at them if they keep trying to absorb that cost, which is why they won't. All right, what's our next question?
How does the bailout of Argentina affect the U.S. and does it what is the bailout?
Well, it's what, $20 billion of what did they call it?
It's like a credit swap.
Credit swaps. Yeah, so it's basically a loan, right?
Yeah, the idea
For
is
all
that
intents and purposes.
you're basically switching $20 billion worth of Argentina Treasury bill loans with U.S. ones.
Yeah.
And so it doesn't actually affect the balance sheet because you're trading in a sense two equal things.
Yeah, that's right.
Um, the only thing is the risk is Argentina has defaulted in the past. If they default again, then you have a loss that would have to go into the deficit, basically for the American.
Yeah, and you could see them doing it again. I mean, they got a lot of troubles with the country with high inflation and some of these
Yeah.
different things. You could see that happening. So the weird part was that Besant is on TV talking about how they're doing this to try to influence the election, which is I don't know. It's interesting to say that out loud. But the farmers are a little upset because Argentina is getting a quasi bailout, even though it's sort of a loanish type
Yeah.
thing, right? But then Argentina has turned around and started making deals with China on their soybeans.
Yeah, they basically, I think they had some sort of export tax that they basically kind of gave or stopped for China's shipments.
And of course, that's the trouble with the whole farming industry at the moment. One of the big areas is soybeans. I think 40 to 60% of soybeans made here in the U.S. were sold to China, and they've ordered zero.
I think the last year they ordered $12.6 billion worth of soybeans, and right now it's at zero.
At zero. And they're holding that hostage this week. They were talking about how they would do soybeans again if they, got rid of the tariffs. Right. So they're, it's a constant back and forth trying to reduce these tariffs and deal with this situation. And so that's one of their political weapons. We have our own weapons actually too. If they want to get Boeing airplanes or some of these different things,
Yeah.
there aren't a lot of airplane manufacturers out there. So, those types of things. So that's the back and forth that'll still happen. But so yeah, I don't know that it affects the U.S. particularly at this point in time all that dramatically. It is just kind of a weird thing. We're picking and choosing. We're giving Brazil a 50% tariff because they are prosecuting a former, president, and we're giving, Argentina $20 billion to help them out.
Yeah,
and
to
so it's
stabilize
just-
them.
Yeah, I don't know. It's a weird policies altogether, and we're, looks like we're about to invade Venezuela at this point. I mean, it's weird what's happening down there too. So there's something happening there as a whole, and I would imagine they wanted to keep at least one friendly place available there, especially if they are going to end up in some kind of armed conflict with Venezuela. So we'll see how that plays out. I think it has much more to do with politics and different things than it does to do with the economy and money even.
Yeah, I don't think the stock market really cares too much about it. Maybe the bond market, if they feel there's going to be a
Yes.
risk, a credit risk, then they'll
Right.
have some sort of repercussion. But
Yeah.
other than that, it's pretty minor.
That's right. All right. What else we got?
So, what factors go into deciding Roth versus traditional 401k contributions during your prime earning years? So, usually we consider prime probably in your 30 to 50s when your income's starting to peak, your high income earning years.
Yeah. So we have different opinion on this by a little bit, but
Yeah.
and this, I think that's interesting. Go ahead and tell
So,
your side, and I'll
So
tell my side.
I'm a believer that if you're in your high income earning, it really depends on your tax brackets. But once you start to push that 24 plus tax bracket, you're starting to get to that point where I think traditional makes more sense. But the way I think about it is, do you have the ability to do Roth conversions? So if you believe that you're able to do Roth conversions at a lower tax rate, at a cheaper rate, then it is better to not pay taxes, to defer your taxes and pay it at a lower rate. But there's other factors that go into that too. Do you have the ability to do this, and kind of are you willing to pay the Roth conversions? I think that's a big thing.
Yeah. Well, I'll say a couple things. First of all, you probably want to be in an even higher tax bracket to make that, you're in the 32 or 37%
Yeah.
bracket on your money. If you're taking that off the top, because it's very likely let's just say the tax tables stay the same, which theoretically they're supposed to now,
Yeah.
right? We'll see how that happens, but if they stay the same, you're often converting in that 22% and maybe 24% conversion level. So if you save taxes at 24 and convert at 24,
It's pretty even.
yeah, it's just a matter when you're going to want to pay the tax. So, but if you're in the 32, 37% and then you're converting at 22 to 24%, that's a pretty good savings. And so I look at it as two different things. It's just my experience. So one is sort of the math side of it. You look at it and you say, okay, if I can save taxes at 32 to 37 and then convert in the future at 22 and 24, that makes some pretty good sense,
Mhm.
right? I mean, you're going to have less taxes paid in total on the same dollar amount. Now, there's some offset there because it's been allowed to grow.
Yeah.
And you're still going to have to pay taxes on that growth, which you wouldn't have had to pay if you would have had it in a Roth in the first place.
Yeah. So, where do you believe tax rates will be is more how you feel about it. So if you anticipate that you will have higher future taxes, then you want to do Roth now. If you believe you'll have ability for lower future taxes, then you want to do traditional. Will your RMDs exceed your expenses too is another conversation. If you believe that you're going to be a low kind of burn rate in your retirement, you kind of want to avoid RMDs, then a Roth may make more sense for you. Another thing is like, will you also be moving to a state that doesn't tax Roth conversions? Because if you're in a high tax state like California for your ordinary income, then and you're going to move to maybe Nevada, let's say, which has no state income tax, then it makes sense to do traditional now. So that's another thing is there's a lot of factors. Also, if there's any kind of future expectation of inheritance or other big lump sums that could stop your Roth conversion income. So if you were to inherit $1 million, when you're doing Roth conversions and this is tax deferred $1 million inheritance, you're going to have ordinary income for that inheritance too. So that affects those calculations too.
Yeah, I guess I just seen what I've seen in the real world, which is the ability in today's world to have a almost completely tax-free retirement is now here, right? Via the Roth, as far as that goes. And so depends on your other assets and what you have and what have you, but instead of having, this giant 401k that becomes this big amount of taxable income that you have to deal with in some form or fashion in retirement, you either try to convert some of it. And so, but the reality of what we've seen is that when people have these large dollar amounts, they don't want to actually convert them.
Yeah,
So that's like, so the math kind of breaks down. So yeah, okay, I saved the tax dollars over here by doing traditional, but now I've got this I don't have a tax-free retirement anymore.
Yeah, you have to pay taxes. Your Medicare will go up too. So it's a tough bullet to swallow, and especially since the years that you do Roth conversion. It's not an easy thing. So it depends on how big your window is for Roth conversions. When do you plan to retire? How long you can use that? Do you have outside assets for the Roth conversion?
Yeah,
And
that's important too. Well, I look at it like, hey, this is available to me today. I can add money to a Roth. It can grow tax-free. I have to pay the taxes on it now. I don't know what's going to happen in the future. I don't know what tax brackets are going to be. I don't know, whether I'll be able to do conversions. Do I have enough money outside of these accounts to do those conversions or not? But I know that today I can start to achieve a tax-free retirement. I get the math, but nobody's doing the math. It reminds me a little bit of the argument of, you're better off taking Social Security and investing the money if you don't need it, right? Because it'll make this lump sum that,
in theory, you could get more than 8%.
Yeah, your break even is, works out pretty well. Math-wise it works, but we've never seen anybody do it. Now, I might do it. Somebody might do it. You might do it. I mean, we're, disciplined enough. We get the math. But just talking about like the average Joe that's out there, we've never seen anybody put that Social Security money into savings, much less investments.
Yeah.
And then secondly, so it's the same thing with this. Will people really have the wherewithal to then do that conversions? First of all, will they be allowed? The laws can change. And so now I've been putting money away, and my dream is to have a tax-free retirement. Not everybody has that dream. That'd be my dream. And then I would have to then do conversions later on in that window between retirement and the retirement, minimum distribution age. So say 65 retirement, 73 is the RMD requirement of distribution. I've got this kind of 8-year period to do conversions. But you could still be in the 32% tax bracket depending on what other incomes you have, but it's more than that. What we've seen is the mental anguish of writing out the big check when you're trying to convert, 100, 200, 400, whatever $1,000. People really struggle writing out that check. It's hard.
Yeah, ideally, if you were in like an ideal situation, you in your 20s through 30s, you were doing Roth, and you'd have like already have some sort of lump in Roth, and then for your higher tax years, you could do traditional. So you'd have kind of like a stool where you have like your tax deferred, your tax free, and then your taxable, where they're kind of equal out.
Right. Yeah, and I think that maybe that's a good solution to what we're talking about, because you don't know what's going to happen in the future. You split the difference, and you say half into a Roth 401k of your contribution and half into a regular. That kind of splits both. It diversifies amongst tax laws. Regular could work out great, especially if the tax rates stay the same or drop, and and your rate is lower in the future. They may make a better deal. You never know. For a while, they had a deal where you could do a Roth conversion, and you could pay the taxes over 4 years, right? So when they first started that, and that was really cool, you could convert, so let's say $200,000, and put $50,000 a year on your tax return for the 4 years. So you never know what they might do. They did that to generate taxable revenue in a quick hit, right? And it was limited. Only had a certain couple of years that you could do it. And we did a lot of it, actually. It was a lot easier it was a good deal.
Yeah, it was a lot easier to stomach.
Well, you're getting kind of a tax-free loan on the
Conversion.
On the conversion, because you're not having to pay the taxes on it all up front. You can kind of keep that. So anyway, I think that maybe that's the way to go. Is kind of a half and half. It depends. For me personally, I do 100% Roth because I'm really, really into the concept of a tax-free retirement. If you do it right, you might be able to have even no taxes on your Social Security.
And I'm on the opposite end where I think once I hit a certain income, I switched to traditional basically. So I did Roth while I was younger when I had lower income, and I'm happy with where it is. And then you make the switch to get those tax benefits now.
Yeah. You're always going to have differences of opinion when the future is unknown. Right?
Yeah, it's a gray area because we don't know. If we knew exactly where tax rates were going to be, what your future incomes, and everything planned out, we can make you the optimal, perfect decision every time.
Well, I think the hardest part isn't so much where the tax brackets are; it's knowing that person and whether they would actually do it. So, because that's the biggest variable. Oh, I got this plan. I'm going to put stuff in traditional and then convert it. Let's say it is available. Does the person actually do it? We've had a lot of clients not do the conversions, or they start and then they don't like writing the checks and they stop. Right. So there's a reality to it that if you truly want it, you have to be able to look at yourself and feel like, hey, I'm going to do this for sure or not,
Yep.
And so that's good. All right. What's another question?
Is there ever a need to have actively managed funds or ETFs in your portfolio? What are your thoughts on actively managed funds?
Well, everything we did when I first started was actively managed. The mutual fund industry actually started in 1929, 1930s as a response to the Great Depression. So, you used to have just a basket of stocks that you bought from a broker, and then they finally said, hey, why don't we just make a basket of stocks, and we'll put this professional in charge, and that professional can buy or sell and maybe get out of the way of some of these ones that are doing poorly and grab onto some of the ones that are doing well. So up until 75, when John Bogle made the first kind of index fund, the Vanguard S&P 500 fund, everything was actively managed. Every mutual fund, and but ETFs, exchange traded funds, came along in a time frame when these indexes, where you just buy a set group of stocks, and they only move based on some parameter that's kind of automated to a certain degree. So they get too big, they move up to a large index. They're too small, they move down or whatever. And so, as far as I'm concerned, I have no problem with an actively managed fund as long as it's doing better, and I feel like it has a chance to continue to do better for whatever reason that might be. Could just be that they're in a niche where actively managed funds do a lot better because the knowledge base, like emerging markets or whatever.
Yeah.
Right.
So if you're thinking about actively managed funds for large cap stocks, I'd probably be against that in a sense. It's very hard to outperform on large cap with an actively managed fund. It would be in periods of high volatility or a down market where actively managed funds may have a benefit because they can get more defensive than actively managed funds,
Right.
or a passive fund.
Right.
But also like very inefficient markets, I think is very like, so emerging markets, small caps can be slightly inefficient. That's where, having some sort of expertise can outperform just the passive indexes.
Right. I mean, there have been examples of situations like with Warren Buffett and Peter Lynch with Fidelity Magellan and Bill Miller for a really long time before things kind of went south with his, forgot the name of his fund. It was a value fund. So, I mean, there have been people out there that have been able to pretty consistently outperform the S&P or whatever markets they're being compared to, even after their expenses, because they're just really good at finding those undiscovered values.
Mm-hmm.
Buffett has a totally different concept. He kind of runs these companies. There's different things, but and nonetheless, there are situations where actively managed. So I don't really care. We're just trying to I'm looking at like fielding a team of high performing investment assets. I got a different slot for different things. Look at it like a soccer team, and maybe have 11 slots. I want the best right wing I can get. I don't care what country they come from or whatever.
Yeah, sometimes you're willing to pay a higher salary.
Yes, right.
You have a budget, and so you try and budget. Maybe some positions get a little bit paid a little bit more
right.
for to have a higher expense ratio, while you have some positions that you just go with the very basic.
Yeah, now there is a strategy out there where people are buying actively managed as part of a diversification strategy. So you've got some active, some passive managed funds. I don't have a particular problem with that. However, most actively managed funds, like 90%, underperform their indexes. So you have to be pretty careful with doing that on a pure systematic basis. You might be consigning a set of your portfolio to underperform forever. So I'm not a big fan of that just from a pure diversification. If it's working and they've got the tiger by the tail, whether that's a passive index or an active managed account, I just want to be in that and try to ride that as long as it goes. It tends to be, for us, oftentimes that it ends up being a passive index that does that.
I think likely the ones that outperform are like small caps, where you start to get like very like micro niches, like small cap value there, or emerging markets in a certain country. That's where having someone with expertise can really benefit you.
Yeah. No, I can. It's nice to have the mixture choice that we have now. We didn't have all these indexes in the past.
So, what is bunching charitable donations, and why should someone do this?
All right, so charitable donations used to be part of, prior to 2017, you got to write off, but after 2017, they upped the amount of the standard deduction so high. I forgot the number. It's 70+% use the standard deduction. Which means that what that means in layman's terms, or in English, is that you don't really get the write-off for
you can't itemize your charitable donations if you don't have enough more than the standard.
Right. And so now they've changed the rules, but still the same concept. You have to have enough, write-offs to itemize, first of all. Then secondly, you have to have enough charitable contributions.
Yeah, you have to be more than 0.5%
Right.
of your adjusted gross income.
So make up a random number. I give $5,000 a year. Maybe I stop doing that and I do 10,000 every other year. And now the limits are easier to manage, but
Yeah,
the same concept, that's what bunching is. It's just basically doing an every other year thing to put them together, hopefully being enough to exceed that 0.5%
yes,
of
to
your
get the tax
income,
benefits.
plus being itemized.
Yeah, with the new tax bill, they also added a new category where you can itemize up to $1,000 per person. So a couple would get $2,000 that you wouldn't have to itemize for charitable donations. So if you're making under,
So even if you're in the standard deduction,
Yep.
right? So you can still now take a write-off for up to 1,000 each
Yep.
on charity without having to be itemizing your whole tax return.
Yep.
Just that one.
Yep.
So that's going to be really well received by charities, because that's one of the problems that's happened here is that you've taken away some of the for
the
people
ease
that
of
were
sake,
itemized.
yeah.
Yeah.
But bunching's nice when you want to try and like make sure you get the most tax benefits for your charities. And so you could do multiple years. You could say, hey, I'm going to put 5 years worth of donations at once to basically have that year that I can itemize, get that low tax benefit. Or you say you have a high income year for unexpected high income year, you could bunch a lot of donations that year to try and write against those too.
Yeah. Excuse me. All right. Well, that's our show for today. Really appreciate everybody that came. We will be back here again next Friday. Looking forward to doing that, of course. And we've got, the daily videos that I do Monday through Thursday. We occasionally miss some, depending on what's going on, but we try to put one out every day. And so send in your questions for next week's show. Ask Tom, talkmoneywithtom.com. We'll get that and have some chance to kind of do some research on it and what have you and get you a good answer. And then, of course, if you want to subscribe to the channel, feel free to do that. Hit the little bell button to get notified when new stuff comes. And, of course, you can set up a time to meet with Ethan and I via the phone, the Zoom, come into the office, whatever works, for 30 minutes. So we do that for free. If you're a client and you got some questions, you can schedule that too. We normally are meeting with the clients on a regular basis, but sometimes things come up in between times. So anyway, look forward to being able to see you again next week, and thank you so much for joining us today.